Hey guys, Vulcan Trader here. So today we're going to talk about moving averages and the trend is your friend. Okay, so you probably heard this saying, you hear it everywhere. It's probably one of the most important things when trading stocks is that the trend is your friend. And what does that mean? It just means that you want to always trade in the direction of the stock with the wind at your back. A lot of people, new traders, don't know what they're doing, will try and buy stocks at 52-week lows. They're going along those stocks, but the problem with that is that the stocks will keep going lower. And so you're always trying to catch a reversal, but the reversal may never come, and it'll keep going down, down to the right. And I'll show here. I can show you right here. Actually, we'll just do this with Nvidia. So Nvidia's been going down, so maybe you thought you were going to buy the dip here. So it's hitting new lows, right? And then there's another low, and then it's going sideways. Maybe it'll come back up. No, another low, and then it's going sideways at this point. Maybe it'll pop back up. Maybe not. You really don't know. You're hoping that it'll turn around, but the trend is not in your favor at this point, and so you want to trade in the direction of the trend with the wind at your back is always the thing to do. So how do you know that the trend is in your direction? It's just by using moving averages. Let me take these Bollinger Bands off here, make it a little bit simpler. But if you look at my other video, I got it in the link in the description for every video I do, is how to set up TradingView, and I show how to set up these trend lines. But all this is a 50-day moving average, just the average price of the last 50 days. This is a daily chart, and then this one is a 200. So the green line is the 50. The red line is 200, and then I've also got a 10-day moving average here. You can put a 20, whatever you want. Or my Bollinger Band I had there was as a 20 in the middle, but I just took it off there to make it a little clearer. But so all you do is okay. So you know that the stock is in an uptrend if in general the price is going from the bottom left side of the chart to the upper right, and the price is above the 50-day moving average. This green line here. And the price is also above the 200-day moving average, and the 50-day moving average, the green one, is above the 200-day moving average. So that is a textbook definition of an uptrend. And so you see, instead of trying to buy, it's whenever it's going down, you buy when it's going up in the direction. Even if you bought it got up here, looked like it was overextended, right? Or if you would have bought it right here, it's like, oh man, that looks like super high overextended, it's gonna pull back. And a lot of people that haven't been trading for long be like, oh, I should go short that. And like, no, you want to go long. Most people aren't going to be selling because they're happy that they're at a profit, and most people will be holding. There is a time it turns around, but 90% of the time it's going to keep going in that direction. The only time it changes is when there's a reversal. You get a stock that's whipsawing, in which case it does that all the time. If you get a stock that's in a general uptrend, that shouldn't happen, and your hit rate will be better. And as long as you position side yourself, it would have pulled back here, maybe the 50 here, but it didn't really matter when you bought it anywhere here, right? You bought it here, you would have gotten hit. Say you use the 50-day moving average as your trailing stop here. You bought it any day, didn't matter, in all these months, and then you held with the 50-day moving average as your trailing stop. You can use any moving average you like depending on the time frame that you want. You could use the 200 if you're a more long-term investor, let's say, or moving average crossover, which we'll get to in a second. So if you'd have bought it anywhere here and then you use the 50-day moving average as your trailing stop, it would have kept going up for Nvidia, and you would have been stopped out here if you used the 50. And so you caught this whole move, and you're looking at, let's see, how long is that? On a stock that most people would think looked overextended. Doesn't matter. Let's say we bought all the way up here, even $50. And you got stopped out at 106, so we're looking at 100% profit right there. So you're buying at brand new all-time highs, and you're selling higher. So you're buying high, selling higher. Whereas if you try and buy low and sell high, sometimes it will continue lower. You don't know. So it's best to go with the trend for that reason. Okay, and then say you use the 200-day moving average. Say you're like, I'm already at 100% profit. I think I'll move my stop to the 200-day moving average. Be a more longer-term investor at this point. So you keep holding. Still never got hit until right here. So in this case, we bought somewhere at 50, 60, doesn't really matter, anywhere around here. And then we get stopped out right here when it closes below the 200-day moving average, 295% gain. Boom. And then the reason you don't want to keep holding on is because, well, look, we would have been at If you'd have kept holding on, think, oh, maybe it'll come back. This is why you need to have stop losses. It's like, oh, all your gains are taken out. You lose, 2/3 of your gain there, because we were at about a 300% profit all the way back down to 100 in this case. And it can keep going lower. If we go into a recession, I would say that video will keep going lower. And then, so the other thing you can do, I was talking about a moving average crossover. So, maybe a swing trader or something would use the 50-day moving average. You might hold for a handful of months. You use the 200-day moving average, it might put you in for a couple years. And then moving average crossover might keep you in even longer. Sometimes not, but it just means that, if you bought it on the opening cross here, say the 50-day moving average goes above the 200-day moving average, that's called a golden cross, and you buy that, and then you wait until it closes below the 200-day moving average. It's a really long-term trend following system for an investor. So you'd have had it down here at 20 and then sold it somewhere whenever this crossed, which would be, let's just say in theory we bought it on the golden cross, and then we held to the death cross, which is the 50 going below the 200. That means we know that's textbook definition. The trend is definitely over on about every time frame is when you get a death cross. Sometimes it'll keep whipsawing up there, but in this case it turned a downtrend. But look at that. Even though you're selling after it pulled back to this, and 869% return. Okay, so that's kind of how you use the price, the moving averages to figure out, okay, is it an uptrend? And then you figure out your time frame, how long or short of a trader and investor you are, to decide how long you want to hold it, and then to know when the trend is over. And so you've got a death cross here, it's in a downtrend, you should definitely sell it. We actually got a golden cross here in NVIDIA, which is funny enough. So you could try and potentially go long here. It's not really, it'd be better. So there's something else here. So you got a golden cross, but we don't have huge volume coming in here. It's not at 52-week highs. This is all other stuff I'll get to in other videos. But just say here why I wouldn't want to take it. I'd probably wait till at least got up here to where we're breaking out above this high. But anyway, they kind of give you a good idea of moving averages, how to use them, and how to use them for your trailing stop, which is good because it's just because it's going up, it's just a good line to use to kind of trail your stop up to lock in profits as it goes. And you just figure out, okay, well, which one of these moving averages is it respecting? It's called the magic line. So the magic line is just on any stock about what speed is it moving up, and so you pick a moving average that's slightly behind and tends to respect and not touch as much, and you use that one for your trailing stop. And it varies from stock to stock. And I think that's it. Like, subscribe, hit the bell, share with your friends, comment down below. Let me know if you got any other questions or good ideas for me to do videos on in the future.